Hey everybody, happy spring. It's just
I hope you're having a great time. Spring is springing up all over the place, and it's a beautiful time. But there are some storm clouds on our horizons. We're going to talk a bit about those today, and we're going to continue on with what we started last week, looking at what you can do to put a plan in place that's going to give you financial security, some guarantees, and much of that growth tax free. So let's get started. We're going to look at some real examples of that today. I want to thank our sponsor, the Simple Plan Community. You can join the Simple Plan Community by going to facebook.com/groups/Simple Plan Community, and that is free. No charge for that. You're going to walk with fellow sojourners who are looking to make the most of their finances in life. We've all been through this or going through it, and it's great to have people to share it with. Also great, you can post your questions, what you're looking for. You can share your experiences. It's great to have a community to walk together with. So join us there, facebook.com/groups/Simple Plan Community. All right, let's just jump right into it. We've got a lot of excitement going on in the realm of inflation and interest rates. This little chart you're looking at here is inflation. This is inflation in the US. The Canadian trend is pretty much identical. The numbers are slightly different in Canada, but only because in Canada we do an even worse job of counting. So as of the end of March, inflation in the United States was trending at about 8.5% annually. Now, the really scary thing on that, or alarming, I'll call it, it's not really scary to me. We're all prepared for it, but if you're not prepared, it is alarming. And the alarming issue is the increase that's gone on, the rate of increase. 6 months ago, inflation was around 2%. So even by the ridiculous way that it gets counted. So I'm pretty sure that most of us know that the way it gets counted isn't really that great, because I think all of us are probably experiencing significantly more than 8.5% inflation in our finances right now. And again, that's the US number. The Canadian number, even more poorly accounted for the end of March, is 6.8%. But again, the trending is disturbing. And you'll notice here, way back in, well, that's really at the beginning of the pandemic. You'll see that inflation was supposedly running about zero, but substantially running around 2% for a long period of time. And now it's quadrupled. And by the way, if inflation's running at over 8%, that means that the real cost of things, the real cost is doubling every 9 years. That would mean in order to keep up, your income would have to be doubling every 9 years. And I think we all know that's not happening. So, interesting and alarming times in some ways for those who are not prepared. Also, interest rates have gone up significantly in both jurisdictions as well. So in Canada, our base interest rate, which is the interbank lending rate, it's referred to often as prime rate. It's not well reported of what this is exactly in the media. They just like the sensational headlines. But the rate that gets quoted is the rate by which banks lend to one another overnight. And I won't get into the technicalities of why they do that. But or that they lend, or that they can borrow from the Bank of Canada. So 0.25%, that is 1/4 of 1%, which is just a quarter point above zero, had been the rate for a long period of time. And we hadn't had much fluctuation in that over the last number of years. It's been up a little more, maybe up a quarter point here, another quarter point there, but came back down. But it went up in April from 0.25 to 0.75. So the alarmist headline would say it tripled, which of course it did. But that doesn't triple the rest of the rates. However, it does drive them up so that everything that has an interest rate attached to it, which is great news if you're savers. Finally, there's going to be some better opportunities for saving with some guarantees, though they still won't be great, but they'll be better. But if you're a borrower, that is, if you have a mortgage, or you have credit card debt, or line of credit debt, or business debt, yeah, that's not good stuff. And so there's a lot of people on variable interest rates on their mortgages, and those mortgages are immediately affected. So their rates are going up. And there's a lot of concern among economists about the amount of debt load that Canadians are carrying and what these interest rate rises are going to mean. So we went from 0.25 to 0.75. In all likelihood, in the next 30 days, we're going to go up another half to 1.25. That means we'll have gone from 0.25 to 1.25 in the space of about 31 days. And by the way, that's the largest single increase, I think, in the last 30 years, going by jumping up a whole half a point. Now, long ago, when I started doing this business, interest rates, mortgage rates were running around 5 to 7%. But now we have a lot of people highly extended, highly leveraged, with rates at 2, maybe 2.5%. So if rates are going to go to 4 and 5 and 6%, and they've got massive mortgages on very, well, just let's call it highly priced Canadian real estate right now. And either they're on a variable rate, which means the rate changes immediately when the interest rates go up, or they're having to renew. They have two potential problems. One is they won't be able to make their payments. That's obvious. But on the renewal side, the other thing that can happen is you can get yourself in a position where you can't qualify to renew because you don't have the income to support the new rate that you're going to have to pay. Now, some mortgages have automatic renewals, and so you'll manage to skate by on that. That's still going to put you in the very difficult position of probably having unmanageable mortgage payments. But you won't be able to shop rates because you won't be able to switch providers because you won't be able to qualify for a new mortgage. So I don't want to be Dr. Doom and Gloom on all this, but things are happening and they're going to happen. And so it's more important than ever that people have a good financial plan in place. And we know that only about 5% of Canadians have a real financial plan that's written and that they're following, has long-term goals, targets, and gets measured regularly and revised to go with that. So again, just to review, the base interest rate tripled just in this first quarter. It's going to increase again. Inflation in Canada is highest in 31 years. Inflation in the US is at 8.5%, up from 1.2% in 2020. Now, we talked last week about a plan that can be a core part of a family's financial plan. And I wanted to get into some more details to that, give a couple of comparisons of the plans most people are using and the plans they could be using, and then look at a couple of examples of families that are using these types of hybrid plans. We call them hybrid plans. What they've done is they've taken really a number of traditional types of plans and combined them together. And both that combination of features as well as the unique times we live in are making it a very worthwhile approach that can bring a lot of opportunity for families. Excuse me. So let's take a look at what's typically happening. So most families have what we call this standard plan. It offers them, so they're looking for financial protection. They'll also have, everybody's got some savings being set aside as well. And of course, as part of our savings, we look to have some guarantees. Not for all of it. We don't need it for all of it, but it's nice. Well, it's not even just nice. It's responsible prudent fiscal financial planning to ensure that you are diversified so that you're not just attached to stock markets. And by the way, I haven't even mentioned what the stock market's done this year, which has not been very pretty either. And definitely in for more turbulence because of the uncertainty of inflation and interest rates, and of course, global geopolitics. Lots going on right now. So let's take a look. Okay, so the financial protection, typical family plan, 10 to 20 years. The hybrid plan offers some financial protection for life, and often will structure it in such a way that they get major financial protection for an initial period, and then just some essential financial protection over the long haul. Now, in the standard plan, there's no guaranteed cash growth. It's just all the money that goes into the financial protection just disappears if you don't end up needing the protection benefits. So there's no cash to access. There may or may not be some modest disability protection, but it's more based on illness than anything else. The hybrid plan has guaranteed cash growth, also an ability to access cash. You can access it. There's a number of ways to access it. You can access it on a tax-free basis, or you can access it on a tax, you'll have to pay tax on a basis. And there's different choices of why you might do that at any given time. But there are tax-free options in there. There is disability protection in there, so if you are significantly disabled, you're able to draw on the protection inside the hybrid plan. So it has bundled into it that disability protection. And did you know that all of us are much more likely to die or to be injured or ill and unable to work for a period of time? There's about a 50% chance of that for people that are 30 years old, whereas the likelihood of dying prematurely is much, much lower than that. Now, there's flexible ways you can contribute to the hybrid plan. There's only one way that you can contribute to the standard plan. And once you commit to it, you have to make those contributions monthly or yearly, depending what you've configured. And there's no avoiding them. If you stop contributing, the plan just collapses. Which leads us to the next feature, which is what we call stop and go contributions. So again, in the standard plan, there's no such thing. But in the hybrid plan, once you've made some contributions to your plan for a few years, you can well stop making your contributions for many months and often many, many years, even decades, with the value that's accumulating in the plan. And so if, for example, again, you're disabled or you have some financial situation that goes on that makes it less viable for you to be making those monthly contributions, you can stop making them, sometimes for very long periods of time, without affecting the plan. Obviously, the plan won't continue to grow through that period at the same pace, but you can also catch up down the road. In the standard plan, you cannot really increase the protection amount. In the hybrid plan, you definitely can. There are no investment options inside the standard plan, whereas in the hybrid plan, there are investment options, and some of those are guaranteed. Others are more linked with markets, and you can even mix and match those if you want to. The standard plan, there's no reduced volatility on returns because there are no returns. The hybrid plan does have reduced volatility on the returns, or what we call smoothed returns. A lot of what really gets to people when we're investing is that markets really go up and down, and we're seeing that quite significantly right now if we look at what's happened on stock markets in the last 6 months. And a lot of people just find that very stressful. Whereas when we use what are called smoothing accounts as part of the investment strategy, we can reduce the volatility or lower the volatility on those returns so that it's not quite so extreme or up and down. And for a lot of people, that helps them to feel significantly more confident about their investing. It's not essential, but it's an option that's available. Now, admittedly, the standard plan has the cheapest contributions, but that's because it has the least amount of features and the least amount of long-term value. For the most part, most people are going to contribute to the standard plan, and it's going to provide them protection, but it's not going to provide them anything else. And that's going to be the extent of what they get. And once they no longer need the protection, all the money they've put into it is sunk cost. It's gone. The hybrid plan has a mid-range cost or contribution level. There are other plans that have higher contribution levels for some great value as well, but probably not for everybody. But the kind of the mid-range plan, mid-range contribution level of the hybrid plan is really what I would call more of the Goldilocks kind of contribution. It's just right. What you're getting is not too expensive, and what you're getting has the amount of value that you need, and it's for a payment that you're likely already making when you look at what you're contributing for your protection and for a portion of your savings. So the long-term value in the hybrid plan is excellent. And then the tax-free estate value, both have tax-free estate payouts. However, in the standard plan, of course, for most people, the vast majority of people, by the time they pass away, they will no longer have the plan in place because it just gets too expensive later in life. Whereas the hybrid plan, that tax-free estate payout is there for life. And so a portion, I mean, you could make it all, but usually it's a portion of your estate is paid out immediately on your death, and it's tax-free. So that's just to refresh you on the features and opportunities of those plans. But let's look at a couple of different scenarios. So we have one family here that's looking for maximum protection. And what that means is they've got young children. So they're at that stage of life where they need to provide maximum protection. And they're looking for a way to grow their cash investments at the maximum guaranteed tax-free rate that they can. Now, note I said their cash investment. For some people, they really like all of the protection and the guarantees and the tax-free benefits, etc., that the hybrid plan can provide, and so they like to put all their investments there. But for many, it's very prudent to just put what you would normally consider the conservative or cash portion of your investments into the hybrid plan while maintaining all your other investments, your stock-based mutual fund type investments, in a separate plan that's in conventional mutual funds. That way you still get the upside growth of the mutual funds in high growth times, but the portion that you're looking to provide that ballast, that balance in a balanced portfolio, is now providing you significant guarantees. In a conventional investment portfolio, you might have something like 50% equities or stocks and 50% in bonds, or maybe even a portion of that in cash. The problem is that bonds, the performance of, well, and the theory behind this is that the bonds and the cash provide some stability, so that while your equities and stocks are going up and down, your bonds during downtime will still help to provide some growth while not providing too much drag during high-performing times for the stocks. However, what we've seen over the last many years is that bonds have been performing poorly, and with interest rates rising, it's forecast that they're going to perform even more poorly. And so bonds have not been a great alternative. Cash has been worse. You've been lucky to be able to get, half a point, 0.5% return, maybe 0.75 on your cash for the last long while. Now, of course, that's going to go up a bit with interest rates going up. But when you compare that with being able to get something like a 3.25% guaranteed return inside a tax-sheltered and tax-free environment like these hybrid plans, that provides much better ballast. So what we're really looking for is diverting our conservative and cash investments over into the hybrid plan while maintaining the investments in our conventional investment plans. So with this family, with the maximum protection, they were getting $1 million in immediate life protection, so that if one of them passed away, the family's way of life would not be compromised. And this was all going to build to, all these contributions would build to $115,000 at retirement age. Now, there was going to be a $250,000 tax-free benefit through their estate at their life expectancy. There's also benefits payable in case of disability as long as the plan's in force up until age 65. And as we mentioned, the premiums could be suspended for years in case they were unable to pay for something. And their contribution for that was under $300 a month for combined savings and insurance protection. That's less than 5% of their income. So if you think about what you might be paying on a monthly basis for insurance, life insurance, disability insurance, and also saving, you should certainly be allocating at least 5% of your income to that. That's really the three big components of your safety net. You should be allocating 5% to that. That's what that 5% of Canadians are doing that are prospering with their money, that aren't experiencing the concerns and fears of inflation and interest rate issues or global politics on the market. And so by just diverting what they were already spending on separate life insurance, disability insurance, and the conservative investment portion of their retirement planning, they were able to get together a much better hybrid protection plan. Now, there's more you can even do with that if you care to. There's ways you can really amp these things up. I'm just giving you kind of a middle of the road, mainstream look at it. There's lots of ways that this can be used even more creatively for tax advantaged income, perhaps even tax-free income in retirement. There's ways it can be utilized for education savings and that kind of thing. But at the level I'm talking about today, we're not kind of adding on all the super bells and whistles like that. All right, and so that's the family. They're young, they've got some assets, but they really need the extended protection, that big safety net, while their family's growing, while their family's young, and while they're really getting well established financially. Now, we have another family who's looking to maximize the guaranteed growth on their cash investments because they're in a pretty good place financially already. Maybe their house is paid off or close to paid off. They've got some good savings, and they're looking for great or a reasonable guaranteed growth on their cash investments again, and guaranteed tax-free payout to their heirs on death. So they're looking at this also as a plan for how they're going to pass wealth to the next generation, all while providing financial protection. So they're looking for the guaranteed tax-free growth on the investment account. They've got $200,000 in immediate tax-free life protection benefit, so less than our other family because they don't need as much right now because they're well established. Now, in this case, the death benefit is going to increase to $1 million at life expectancy because they're planning to pass a significant portion of their estate through to their heirs, their family, their loved ones, or even their favorite causes this way, because this provides three major advantages. One is it flows tax-free out of the plan on death. The second is that it avoids going through the estate, which means that payout happens in a matter of maybe a couple of weeks, as opposed to taking months or even a year or two for the process of probating the will to happen. And finally, the probate fees don't apply to this either. Maybe two added features as well. It's all creditor protected. That is, these funds can't be, if you end up in a financial difficulty at some point, these funds cannot be accessed or assailed by creditors. And it's all private. Wills are a matter of public record. So whatever goes through your estate through a will goes through the public record, and anybody can find out about it. But if you're not wanting everybody to know what you left your money to or portions of it, a life insurance payout is a completely private, confidential, protected matter, and no one else will know what happened other than the beneficiary. So they've got $1 million flowing tax-free on their death to their estate, and that's a plan, so that will happen when they pass away at life expectancy, hopefully. And again, benefits are payable up to age 65 in case of disability. Premiums can be suspended at any time if you need be, if there's some reason you don't want to make the contributions for a while. And in this case, they were making a $500 per month contribution for the combined savings and insurance protection. Now, again, they're still continuing with a significant portion of their investing program going into other vehicles like mutual funds so that they get the increased growth. So they've divided things out. They've got guaranteed growth. They've got a significant estate plan, and they're still taking advantage of the growth in investment markets. So this is how we look at combining the features of these various plans into this hybrid plan now that just makes more sense than it ever has. So there's hundreds of thousands of Canadians that are already using a plan like this. However, most are not taking full advantage of it because they're just not aware of the opportunities that are there. Also, they're not using the right vehicle. They don't have this. This is a new product that's been put together that really combines the features that were only available in a few separate products before. Now, the other thing, there's a few questions we get asked. Well, can't I just do this myself? Do I need to work with an advisor? And there's a few answers to that. The first is, well, this is a fairly complex strategy, so you probably want to work with an advisor, first off. But I would say, secondly, you can't actually get access to most of this product. Some of these products you can attempt to get on yourself, but you really have to work through an advisor to get them. They're not available through any public channels. But you really do want an advisor helping you with this because there's all sorts of tax planning that needs to go into it. The structure of it needs to be done right so that you get full advantage of the tax strategy and you fully understand what is guaranteed. It's very important that you thoroughly understand these plans because they're part of a long-term plan and you want to be sure that things are structured exactly the way you want them to be. So here's our offer for today. If this sounds interesting to you, we're offering all our viewers an opportunity to sit down and let's just have a look. Let's just have a chat. I don't know if this is for you or not. This isn't for everybody. Not all families qualify for this type of a plan. But if you want to, we're happy to sit down with everybody. You can book a time. You can go and book it right now to sit down. We'll spend about 45 minutes just getting to know one another and looking at your individual situation and determining whether this might be a fit for your family or not. So you can go to go.getthesimpleplan.com/calendar-new and book your time right there that suits your schedule. Now, if for those that have a partner or married, we ask that both of you be present at that meeting. This is a generous amount of time and explanation we're going to go through. And so it's very important that everybody that would be significantly involved understand what it's about. And so it's we insist actually that both spouses or partners be there if we're going to get into this. And we love to help families with this. We can tell you that you will experience, really in the first 60 days, you'll start to experience a significant level of financial freedom as you recognize you've kind of got all these different bases covered now in a significant foundational plan that will land for life for you. And so I'm putting in the comments there, just waiting for it to come up. There we go. There's the link again. You can find the link in the comments if you're watching this on Facebook. just go ahead and click that link and you can go book a time. We'd love to sit down with you and have a free chat. Now, we're going to, over the next few weeks, be unpacking a bit of information about these particular plans and features. And so you're going to see some of the detail level and get a clearer understanding of what some of this is about and how it could affect your family in just the best possible way financially for life. So that's it for today. Again, we invite you to book a time, go to the calendar, book a time, and we'd love to sit down with you and just find out if we can help your family as we've helped hundreds of other families. We want to thank our sponsor, again, the Simple Plan community. That's at facebook.com/groups/Simple Plan community. Join the group, it's free, and we'd love to have you there, walking together with you. You bring your questions, we'll bring the tools, the ideas, and help you make your way through planning all your finances for life. Thanks again. I'm Brad Macbeth with the Simple Plan. It's been great to be with you today, and we look forward to being with you again next week.